Hey, everybody. Welcome back. Welcome back after the long weekend. Hope everyone is doing okay. Let me know in the chat here, please, if you can hear and see me okay. I think that yesterday's day off was the last holiday off that we're going to have from the markets, probably till Good Friday. It seems like, man, over the last several months, from kind of Thanksgiving on, we've had what seemed like an extra day off. So, I think that's it. I think that's it for a while here. So hope everybody had a great weekend. Touch of uncertainty, not a touch. There's a lot of uncertainty in the market right now. We're seeing very, very low volumes today and, hovering right around the flat line or so. And there's just so much going on geopolitically coming out of the White House. Who knows what's going to happen? Supposed talks with Russia, Ukraine, blah, 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 blah. So, very, very low volume today. So, you know what? We've been really, really busy, really active. And on days like this, or if there's a period of time like this, not that we don't want to trade, of course that we do. Oh, I hate this cord here. Come on, get behind me. We do, but we're never going to force anything, guys. So, we just kind of let the market come to us and sit back and kind of go from there. So, how many of you have ever traded or understand what a ratio spread is? Now, sometimes in some of our broken wing butterfly spreads, we will do a ratio in terms of 1 to 3 to 2 as opposed to the normal 1 to 2 to 1 butterfly. But what about a pure ratio, like a 1 to 2, a 2 to 3, a 3 to 5, whatever it might be? How many of you have ever done anything like that? Because we don't do a lot of those here, but they are an important tool. They are an important strategy, and you really should know how to do it, how to use them, or at least understand them. When would be the appropriate time to use them? Now, before I go on, we got to get to 20 likes right now. Mike Clark, how many likes do we have right now? You got to smash, smash, smash. No, you do not have to have a lot of money to do those. Absolutely not. Absolutely not. We will show you why. Okay, on one side of them you do, on the other side you don't. Mike Clark, how many smashes do we have right now? I'm not moving on until we have at least 20 likes, guys. Do we have 2016? That's 4. Come on. Come on, everyone. Hit the like, smash the like. There we go. Thank you, Stephen. Thank you, Stephen. All right, what are we up to right now? 22. Let's go. Let's have at it. Okay. So a ratio spread, everybody. Okay. The definition of it is really just what it sounds like. It consists of an option spread where there's more contracts on one strike than another. So rather than just a 1-to-1, like we do 99% of the time, you could have a 1 to 2, a 2 to 3, a 4 to 5, whatever it might be. It's an uneven amount. Now, there are two types of trades, two types of ratios that we can put on. And Gary, I think that was you before that said it costs a lot of money to put on a ratio spread. Well, it only costs a lot in terms of margin, if that's what you were referring to, if you put on what's called a front ratio spread. A front ratio spread means that the amount of options that you are selling is more than the amount you're buying. So you have a naked option or naked options. Okay, a back spread, a back ratio spread, which is what we would do here, and I will explain why and all the differences of everything, is when you have more long contracts than short. And this is probably what you were talking about, Gary, is that we typically do not trade a front ratio spread because we would have short units. Okay. When I talk about units, I'm talking about the actual options, calls or puts. Okay. Whether it's call or put doesn't matter. but short units, meaning that we have sold more than we have bought. Your brokerage firm does not like you to have short units, and they will charge you an arm and a leg margin wise. Very similar, very similar to when the very infrequent time we look to trade a wish list type of trade. For those of you that have done that or have followed along as we've discussed or know what they are, a wish list trade for us has a naked short put to it. So it could be a ratio where we have 2 longs and 3 shorts, 5 longs, 6 shorts, something to that effect, but where there is a naked short option. Now, we will never do that on the call side, okay? Because as we're going to kind of go through here, if you have a naked short call, regardless how far out of the money it is, your loss is theoretically unlimited because a stock can keep going and going and going and going forever. Your margin on that type of trade, most of you probably would not be able to afford that margin. So when we do a wish list on a ratio and we have a short unit, that short unit being on the put side, well, yes, we know what our maximum loss could be. Unlike on the call side, where a stock can go forever and ever and ever, to the downside, a stock can only go to zero. That doesn't mean there's not a lot of potential loss. There is, but that is measurable. Okay, so let's talk about that front ratio spread. Okay, and you can do it either with a put or a call. Okay, if you're bearish, you can do it with puts. If you're bullish, do it with calls. Okay, and again, that's where you have a higher quantity of short options rather than long ones. Okay, so what we are looking to do, or the time you would want to do that, okay, think about this, guys, and I have it up here. When do we want to sell options, right? When is the most optimal time to sell options? Yeah, exactly right. When options are expensive, when volatility is expensive. Okay, so that is a really good opportunity. But because of the limitations from our brokerage firms of having naked options, we get limited a little bit. So sometimes we have to get creative in how we are able to sell that high volatility. Okay, but a call ratio spread, okay, a front call ratio spread would be buying one call. Okay. And typically we would look to do that at the money ish and selling 2 further away or further out of the money calls, or buying 2 and selling 3. Okay. A put ratio front spread is the exact opposite. We're just using puts. So you would buy an at the money put and then sell more out of the money puts, or 2 to 3, 3 to 4, whatever it might be. Okay. Now, what are the benefits and what are the risks? Okay. The benefits are obviously that if we're selling more options, we're selling expensive options, we're collecting premium. Okay. Or we're collecting more extrinsic value. Whether, again, it's on the upside call side or the downside put side. Okay. Just like, think about when we do our ratio butterflies. Okay. And we do them 1, 3, 2. What are we actually doing? We're actually selling one extra spread, right? Rather than 1 to 2 to 1, where we have a long spread and then a short spread. In a 1 to 3 to 2, we have a long spread and 2 short spreads. So it's not a ratio where we have an uneven amount of contracts, but it's a ratio outside of our norm of 1 to 2 to 1. And we do that when there is super high volatility. Does everybody understand that? We're selling an extra spread. Now, we could just sell an extra option, sure, and collect even more premium, but we keep it to those consistent long and short units so that we just don't get hit with massive, massive margin costs. Does that make sense to everyone? Okay, before I go on, I need 35 likes. I don't know where we sit right now. Mike, you've got it. I need 35 likes. Sitting at 31. All right, let's go. I know there's about 100 of you or more right now out here, and we've got 31 likes. All it takes is 4 more of you to just hit that like button right now. $33. Thank you, those last 2. Can we get 2 more? Guys, I know it. There we go. There's 35. It really helps us the way that YouTube, does their metrics. Liking these things, it really helps us out a lot. So here's how you would put on a front ratio spread. Okay. The typical format, like I said, it's buying an option, buying a call, maybe right at the money, and then selling 2 out of the money options. Thank you, Mark. Okay. And then same thing on the put side, buying an at the money. And it doesn't have to be at the money, right? You can use in the money or out of the money options. Okay. Typically, the way we would do it, though, is buying that at the money and selling more out of the money options. Oh, this cord is killing me here. Okay. And then here is what the dynamic of the front spread ratio would be like. So on the put side, it's a neutral to bearish strategy. It's a neutral to bearish strategy. And you can see here that if this is where current stock price is, okay, to the upside, it's pretty much a flat P&L because it's not going to cost us anything. Maybe we even collect a little bit of a credit. Okay. So it's really not an upside play. To the downside, we will profit. Okay. To what point? To what point would this peak out at our profits right here, everybody? Remember what we always say. We actually had a discussion about this morning in OpVol. But remember what we always say, Gilbert, thank you very much. Yes, this peak right here would be the short strike. Robert, thank you. That peak would be the short strike. That's the point where our long option maxes its value while the short option, or in this case, the short options, are worthless. But what happens is on the put side, if the stock keeps going lower and lower and lower and lower, what happens? We don't have a 1-to-1 ratio. All of a sudden, those 2 short options are going to take over from a delta standpoint. And the lower and lower and lower the stock goes, the worse off that's going to be. So the benefit of a 1x2, and I'm just going to keep it a 1x2. Again, you could do 2x3, 3x5, whatever it is. The benefit of doing a 1x2, excuse me, is that you lower your cost. Excuse me again, guys. Sorry. You can still have that downside move. You lower your cost. Optimally, you're targeting that short strike, but you have to be aware that, God forbid you get a stock that really drops off the face of the planet here. Your P&L is really going to go with it. Now, you can do this. Your clearing firm will let you do that. Your brokerage firm will let you do the put side of it. They will charge you more margin. But again, we know what the maximum liability would be because the stock can only go to zero. But on the call side, okay, very, very similar, almost a mirror image, okay, of the graph here that we looked at on the put side, where we have our long call. We're going to have our peak right here, our peak profit right at the shorts, at the short strike. Okay. You do this typically for credit. So even if the stock goes down, doesn't cost you anything. It's a bullish strategy. Okay. It's a neutral to bullish strategy. But even if the stock goes down, you don't lose anything. However, as Gary just said, on the upside, your P&L because we don't know how high a stock can go, you have theoretically unlimited loss. Now, I'm not telling you to never, ever trade something like this. Okay. In fact, if you are very diligent and you are very attentive, okay, these can be unbelievable spreads. These can be unbelievable strategies. What do you think, timing wise, would be the biggest risk that you would have to putting on a front ratio spread, the kind of spread where you are short a unit? When do you think you would have the biggest risk? John, you don't maximize your profit if the stock decreases there. Not at all. I'll go through that in a second. Okay. The most risk, I don't want to say the timing of where your most risk is overnight when the market is not trading. So the market closes at 3 o'clock one day, you have this position on and it's looking great, blah, 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 blah. Whether it's earnings or something else, if news comes out about this particular stock that sends the stock skyrocketing or plummeting either way, overnight, while you don't have the opportunity to manage it, that's where your risk is. If it's intraday and the stock is really moving around, okay, you can get in there and you can trade around it. You can manage the position or get out if you want. The big risk to this is that something happens overnight. Okay. Now, John, you had said that the biggest or the best thing you would want on this front call ratio was for the stock to move down. Okay. And that's not the case. If the stock moves down here, typically you're going to make a little bit of credit. Whatever your credit was, that's all you can make on the downside. So you are protected on the downside. Your biggest profit area, though, is always at the short strike. So we would, in this case, want the stock to move higher to get to that short strike at expiration. Okay. Gary, my friends at the Cboe tell me it is in the works, but more than likely not happening in 2025. John, does that make sense to you before we move on here? Okay, can we get 45 likes before we move on, please? Michael, where are we at? Can we get 45 likes? 43. Okay, great, John. Come on. There's over 100 of you out here, and 43 of you have hit the like. Smash it, smash it, smash it. Come on. I want to move on. There's more info here, but I'm not doing it till we get to 45. 44. Man, this is like pulling teeth. Bingo. Thank you. There we go. Okay. So as we just discussed on the front ratio here, your max profit, okay, your max profit is going to be right at the short strike. So the distance between those strikes, whether it's $1, $2, $5, it's going to be that plus your credit received. Same thing on the call side. It's going to be the distance between the long and the short plus your credit received. And where is the max value? Boom, boom, boom. Short strike at expiration. Okay, now a back spread. How many of you heard of a back spread? Not necessarily a back ratio spread, but a back spread. Okay, a back spread. That's the way when I traded on the floor, I traded probably 95% of the time with a back spread, meaning that I was always long units. I had more long options in my account than short ones. And what happens is you get a P&L that looks like this. Okay. And that's why it's called a back spread. You're holding this up on your back. In a situation like this, okay. Nope. Robert has nothing to do with backwardation. Two totally different things. In a situation like this, where your P&L looks like this, you want movement. You want the stock to move all over the place, or you want the stock to move as far in one direction or the other. You make more money as the stock goes down. You make more money as the stock goes up. What you don't want is the stock to sit still, because that's when the theta comes in. So here you're buying more contracts than you are selling. So we have done this in the VIX before. And the way that we would construct this is by selling one close to at the money option, but then buying two slightly out of the money options. Okay. Now, when would be the best time to do this? If we are buying extra options, buying extra units, when would be the best time to do this? To put on a back spread position. Think of it this way. When, not earnings related, when would you ever want to buy a straddle or a strangle? When would you ever buy a straddle or a strangle? Again, not for earnings. It's a different animal. Bingo, Robert, you got it. When vol is cheap. Gary, exactly. This is a fantastic position. No, Jake, it's just the opposite. We want to buy those extra units when vol is really cheap, when it's on sale. Okay, so a back spread, okay, is a combination, one short, two long, or again, three short, five long, whatever it is. The maximum profit, if you have a call back spread like this, a call ratio, infinite. Because just as we just talked about, if you have a short ratio on the call side where your loss is really undefined or infinite, if you have the long part of that and you have one extra option, your potential gain is infinite. Can't figure it out. And the max profit on a back ratio put spread, okay, where you're long more puts than you're short, would be at zero. Just like that would be the max loss if you had the front spread on, if you were short extra options. Here, your max profit would be at zero because all of the options would be maxed out. So we're going to put this up here, let you guys put up word of the day here for a second. Then I'm going to show you a couple live examples here. Okay, so let's get that up here. Okay, and let's just look at an example here. I'm just choosing Netflix for no particular reason. For no particular reason. And I'm going to show you what the P&L would look like if we were long units. And let's just, let's see, 1035. So let's say we sold a 1050 call and we bought two 1060s. Okay, here is what your P&L is going to look like. Okay, here is your ratio call spread, and you can see the profit just keeps going higher and higher and higher and higher because you own one extra call. Does everybody see that? Okay, your loss is limited to whatever you pay for this. You have unlimited profit potential. Now, let's flip this over and look at the opposite of that, where we're buying the at the money, but then selling two out of the monies. Yikes. Yikes, yikes, yikes. Okay. It's basically just flipped on its head. It is flipped on its head. This is why your brokerage firm, your clearing firm would never allow you to do this. Or I shouldn't say never, it depends how much money you have in your account. They would not want you to do this. Okay, now let's look at it on the put side. Let's use a different stock, maybe something that's not quite as expensive. Here, look, I just chose Starbucks randomly. Okay, so let's look at a put ratio, a back put ratio. Okay, here is what you're going to see here. This is where you're long one extra put. Where do we make the most money? With the stock going down, 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 all the way to zero, because we have one extra long put. Okay, and if we do that on the call side, okay, where we buy one at the money, but this time sell two out of the monies, boy, we're going to want people to stop drinking coffee if that's the case. Yikes. Timber falling off a cliff here. Okay. Now, last thing I want to show you. First, let me put Hulkster back up for those of you that didn't get the word. Here we go. I'm going to show you one more thing that we get the actual back spread curvature where we want to see a stock moving either direction as much as possible. Okay. So that would be, let's use a different stock here. Let's use App. Okay, App's $490. If I buy the 490 straddle, okay, that means I'm buying a call and a put. I don't care which way this thing moves. I just want to see it move. Or I want to see it moving back and forth, back and forth, back and forth. This type of position right here, that is known as a back spread. A back spread position where you want maximum move either direction or a lot of back and forth, back and forth, back and forth, so you can scalp your gamma, scalp your stock, which we can talk about another time. Okay. Surprise, surprise. I'm reading a headline right here coming out between that just came out from whatever the Ukraine Russia talks were. Putin allegedly not seeking a real peace deal. Surprise, surprise, surprise. Anywho, let me show you the last thing here, guys. If you had what's called a vertical or a short back spread on here, okay, where we were short options rather than long them. Let's look at Shake Shack here. Let's say we were to sell a strangle, not a strangle swap where we sell a strangle and then buy another one against it, but purely just selling both a call and a put. This is now the opposite of a back spread, and it's called actually a front spread or a vertical. Where do you make your most money on this? Right here. You don't want it down here. You don't want it down here. Does everybody see that? Does that make sense? Okay. Again, I would not really look to sell the ratio only because of the margin issue. And when I say I obviously would do that for myself. I am experienced enough and can manage it. I wouldn't really put a position out like that for the room, other than the wish list, which is something different, and we talk about it. But the back spread, when vol is super, super, super cheap, that is the most optimal time to do that. All righty, we know what time it is, guys. And just to let everybody know, the latest batch of new swag was just sent out. Okay, we've got the new swag in hand. If you've been waiting, it was just sent out. Okay, it's a new week. If you won last week, you're still eligible this week. Here we go with the ratio spin of the wheel today. Today's winner. Who are we going to be? Randall V or Rick? Randall. Randall V, are you in the house? Are you in the house? Amazing. Nicely done, Randall. Nicely done. You know what to do. Shoot me an email. We'll post it up here. Shoot me an email at prosperswag@prospertrading.com with your mailing address and size swag. All right, everybody. Thank you, thank you, thank you. Really appreciate it. Let's take a look what the market did on that news coming out about Putin. Nothing really. S&Ps are literally hovering at the flat line right now. So nothing to write home about. All right, guys. Hope you all have a fantastic day. Really appreciate it. Randall, nicely done. We'll see you all tomorrow, everybody. Have a great day.